The market is currently closed and SoFi Technologies Inc., trading under the ticker NASDAQ SoFi, last closed at $28.49 USD on Tuesday, November 26, 8 p.m. GMT-5, reflecting an intraday gain of $0.16 or 0.56%. The after-hours movement continued this subtle upward momentum, ticking up another $0.051 to $28.54. The common expectation for SoFi, driven by its recent string of profitable quarters and aggressive growth in member count, is that it's finally shedding its high-risk fintech label and morphing into a resilient, fully regulated bank holding company. This narrative, while accurate on the surface, misses the critical immediate reality. The recent stock movement and the stock's overall climb this year is less about its core lending business and far more a leveraged play on two external forces: interest rate optimism and a significant, though often quiet, institutional accumulation that has absorbed much of the selling pressure from earlier in the year. The intraday action on Tuesday, where the stock oscillated between a low of $28.31 and a high of $29.25 on a volume of over 56 million shares, demonstrates this tension perfectly. A 94-cent swing is considerable for a stock at this price point, and the late-day recovery from the low suggests robust buying support, stepping in just as the initial midday profit-taking attempted to push the price down toward the previous close of $28.33. This sort of pattern, where the stock tests its immediate support only to be bought back up, is a strong indicator of conviction from large players, signaling a willingness to acquire shares at the low end of the daily range. The conventional wisdom focuses on the headlines of member and product growth, which are indeed impressive, but the real story is in the institutional flow. Major asset managers like Vanguard and BlackRock have been actively increasing their positions, a pattern visible in the latest 13F filings. This is what truly underpins the expectation of stability and future appreciation, as these firms are signaling a long-term belief in the business model, effectively providing a floor for the price action. However, the primary challenge to this widely held optimistic view is that the stock's valuation, as reflected by a P/E ratio above 50, remains elevated compared to traditional bank peers which operate with much lower multiples. This discrepancy forces investors to price SoFi not as a bank, but as a high-growth technology platform, which is what the company ultimately aims to be, blending its banking charter with its Galileo technology platform. The core of SoFi's business is built on three segments: lending, technology platform, and financial services. The lending segment, historically the largest and most profitable, is heavily exposed to the macroeconomic climate, particularly interest rates and student loan dynamics. While the return of student loan payments has provided a tailwind for their refinancing business, the high interest rate environment continues to apply downward pressure on the valuations of newly originated loans and increases the company's funding costs, even with their bank charter providing cheaper deposit funding. This creates a fascinating disconnect. The better-than-expected earnings reports are often driven by successful cost management and non-lending revenue growth, which temporarily reduces the perceived risk from the lending side, leading to a stock price surge. Yet, a large portion of the market is simply trading the possibility of a Federal Reserve rate cut in the coming quarters, which would dramatically ease pressure on the lending side and send the stock materially higher. The recent consolidation near the high end of its yearly range is a holding pattern, investors waiting for the Fed's next move, treating SoFi as a high beta interest rate proxy. Now, let's turn to the short-selling awareness, a crucial element in understanding SoFi's volatility. The stock carries a significant short interest, sitting around 9.8% of the float, representing over 116 million shares shorted. While this figure is not in the extreme short squeeze territory that dominates conversations on platforms like Reddit, it is certainly high enough to matter, especially with a days-to-cover ratio hovering around 1.75. This means it would take nearly 2 full days of average trading volume for short sellers to cover their positions, a low number but still a potential friction point on a major upward catalyst. Furthermore, the short sale volume in the off-exchange or dark pool market has been noticeably high, recently hitting over 40% of the total off-exchange volume. This sustained shorting activity, particularly through less transparent channels, is what fuels the retail investor debate about market transparency and coordinated pressure. The short thesis is straightforward. The valuation is too high for a company whose main profit driver, lending, is cyclical and vulnerable to credit default risks in an uncertain economy. Firms like Susquehanna International Group LP have notable put positions, indicating a significant bearish stance, lightly betting that loan loss provisions will rise faster than revenue can compensate. The actionable insight here for the retail investor is twofold. First, monitor the short borrow fee rate. Currently, the rate is low, around 0.29%, which means it's cheap for short sellers to maintain their positions. A sudden, sustained spike in this borrow rate would be an early warning sign of a potential short squeeze developing, as it indicates a scarcity of shares available to short. Furthermore, track the failed-to-deliver data. While recent failures to deliver have been minimal, a sharp increase could indicate settlement issues tied to aggressive shorting or naked shorting, which is a signal that intense synthetic pressure is being applied to the stock. The current low borrow rate and manageable days-to-cover ratio suggest that while the pressure is present, it is not acute, and the short sellers feel comfortable maintaining their positions for now, believing the stock will eventually revert to a lower, more traditional, bank-like valuation. Do you think the major short sellers will be forced to cover if SoFi hits its 5th consecutive quarter of GAAP profitability, or are they pushing fear based on genuine credit cycle risks? Comment below what your take is on the rising short interest in high-growth fintech names like SoFi. The company's strategic vision is to become the AWS of fintech through its technology platform, Galileo, and to become a financial one-stop shop for its affluent but underserved millennial customer base. Galileo, which provides core processing and program management for other fintechs, is capital light and high margin, representing the true growth anchor that justifies the current high multiple valuation. The ability of the company to cross-sell products is critical, from credit cards and personal loans to brokerage accounts and mortgages, to maximize the lifetime value of each new member. Recent earnings have shown accelerating momentum in this cross-selling, and the financial services segment, while still loss-making, is quickly moving toward profitability as economies of scale kick in. The path to long-term success is not just about adding new members, it is about driving up the product per member count and achieving a critical mass of non-lending, fee-based revenue that smooths out the cyclical volatility of the lending business. Looking ahead, the most potent catalysts remain the macroeconomic ones. Any definitive signal from the Federal Reserve that the rate hiking cycle is over and that cuts are on the near-term horizon will act as a major spring for SoFi's price. Analyst price targets currently offer a mixed picture, with the average target often sitting slightly below the current price, creating a hold consensus that reflects a wait-and-see attitude regarding the high valuation versus the execution risk. The range in price targets from a low of $12 to a high of $38 encapsulates the profound disagreement in the market. Is SoFi a traditional interest rate sensitive lender that is grossly overvalued, or